These are both loan structures. Generally, safes are much more favorable to entrepreneurs because they're not, there's no interest that accrues. So if you borrow money, borrow $1 million and put that into a convertible debt structure, then that's going to accrue interest every year. So if it takes you 3 or 4 years to convert that into a Series A, which is a priced round, that investor is going to gain interest on their investment. So you can get a safe done. I highly recommend it. Safe documents are available online. You do want a real startup lawyer to help you incorporate the company. You want somebody helping you go through these financing documents. That makes you look more robust in front of early investors. Your type of investor that you're targeting, it is the friends and family round. So it's often exactly that. It's friends and family. I also encourage people, if they've had employers at their last jobs, I found that a lot of people who I didn't think were traditional angel investors, like these weren't the people that were on angel list, they weren't the famous angels that you see or tech entrepreneurs. They were actually people who had I worked for previously, and they were really willing to write a $25,000 or $40,000 check behind me. And so those are the typical people that you're pitching. I don't recommend skipping the stage because you learn so much about the types of questions investors ask. You learn promotion questions versus prevention questions. You learn questions about structuring the round. I had an entrepreneur I knew recently who had 3 different angels. Each were willing to invest $50K. Each wanted a different structure. One wanted safe, one wanted equity, one wanted convertible debt. And instead of just saying no to 2 investors and saying, this is the structure and we're going to go forward and you can invest, and then convincing the other 2, he lost all 3 of them. And so those are the types of things you don't want to happen when you're talking about raising a lot larger sums of money from, micro VCs, etc. I can talk more about financing. I think I saw a couple questions in the chat, so I'm just going to pause. Most all investors at friends and family stage be accredited. Generally, yes. There's been some changes to the regulations recently. The short answer is yes. It cleans up your cap table. It avoids any issues down the line. I know I took one investor that was not accredited, and I managed to skate under the radar. But it ate at night when we'd go through diligence, Series C type of diligence, because one person wasn't really accredited. Let's see. No more questions. Okay, we'll move on to sort of what it is that you do. Now, let's assume you raise some money or you're in the process of raising money. What do you do? What does the company look like? What are the milestones that you're hitting? Generally, in the friends and family round, it's typically just founders, usually founders. I'm really a sole founder. I've never had co-founders. I almost had co-founders in my first 2 companies. We can talk about that later. And you do not have a board of directors. The board of directors' job is just to hire and fire the CEO and make sure the company does not get sued. Those are like the main responsibilities of the board. At this stage, you don't know what you're doing. You're iterating on a product, it's an idea on a cocktail, and so you really are not. You don't want the governance factors coming in here because you're just not ready. In terms of compensation, you want to founder, you almost had co-founders. That was myself and them, which is they want to continue and match their salaries and didn't want to take any risk, and so you really don't get that privilege. If you want to be a founder, you really have to be willing to take no salary for a predetermined amount of time. If you do have co-founders, there's always an option pool, something people forget about. So when you incorporate the company, you have real lawyers, not your friend who's a real estate lawyer helping you incorporate the company. You'll have a cap table, and the cap table will have an option pool. That is how you grant equity to advisors. That's how you grant equity to team members that come in the future. And that pulls out of your overall equity. So it's not like, even as a sole founder, I don't own 100%. I would own 90% and 10% in the option pool from which allocations will be made. Founder splits do not have to be equal. And in fact, even if you do have co-founders, I very much recommend that they are not equal. So you typically see like one founder may have 50% and 2 other founders may have 20%. And that's a typical structure for whoever's taking the most risk, who's the CEO, who quit their job, who doesn't have income, and other people might be doing it part-time and coming in later, or the risk appetite might not be as high, they need a salary. All of that factors into how the equity is divvied up. In terms of key metrics, hey, it's the friends and family round. Like, you're really raising a very small amount of money, right? The idea is to incorporate the company correctly, get real lawyers on this, make sure you have all the right structure so that you can grant equity. These are kind of like the minutia things that not everybody talks about. And you want to have proper employment docs. All of that goes into what ultimately becomes a data room in the future. The product is really an idea on a cocktail napkin, and it's the ability to create a deck. And the deck is, problem, solution, total addressable markets, all this research that goes into, if I had this product, who's going to pay for it? What is it going to do? This is what we're gunning towards. Here's how we'd hire. This is the type of compensation it would require to hire this person in order to phase of the company. So you're really mapping what you're going to do in the future, and you're really trying to get those early conversations with the customers. So I'll pause here to see if there are any questions. Do friends and family get preferred shares, or only the co-founders who put money in? Great question. Preferred shares are for investors only, and founders can be investors. My first time around, I did sweat equity, which was, I would take out money and, go to Staples or Kinko's and print. All in, I ended up spending about $25,000 of my own money, but it never went in as $25,000 as a single check. And so that was considered sweat equity, and I did not get preferred shares for that. I got reimbursed like at the Series B or something like that. It took many years, like 5 or 6 years, before I was paid back for that $25K I put in that first year. Otherwise, the only people who get preferred shares are investors. If you are a founder that writes a check for 50 or 100K, then you absolutely have the ability to get preferred shares, and I highly recommend you do that. Second company I put $100,000 into, I opened up a friends and family round, and about $1 million of investors followed my 100K because they saw how much commitment I had to my company. So yes, you can do that. We'll move on to the next slide, which is just some general reminders about the friends and family round. So I mentioned, having proper incorporation documents, getting everyone teed up correctly with their employment contracts. Everybody vests. I, as the founder, vest. You, as a co-founder, might vest. All advisors vest. All employees vest. Nobody just gets a equity with no vesting. And there are different types of vesting structures. The most favorable happens the earliest on, when there's the most risk, which is a 6-month cliff and a 3-year vest. So if somebody quits or gets fired in 6 months, they get no equity. They didn't hit their cliff. 6 months and 1 day, it's as though the cliff never existed, and they've vested for that 6-month period. This is also a period where you might see RSUs, restricted stock units. Restricted stock is basically more favorable than options, the option to buy equity in the future. And these grants often happen before a pre-409A valuation. So these are all sort of mechanics that happen in the future, but this is the earliest, most risky stage of the company, so you have more favorable equity grants. I will say the world is leaning towards 1-year cliff and 4-year vest, so this is like a very unique time that you can get this. There was a question about do founders get preferred shares? You don't need a lead investor, but if you're a founder who's investing and putting a good amount into the company, again, it's like a $150K round. If you're putting $25K in, you can anchor and open that round and say, here are the terms that we're raising on. And those terms, that's called a party round, when there's no formal lead investor and just a group of people come together as a party to invest and agree on the terms. Yeah, you could set the terms really high. You could set it at a $10 million valuation. That's not market, and it's going to be very hard for other people to follow you. And then you have to think in the future, if I set the valuation too high, I'm going to have a down round. That's going to be devastating. You get like one down round in the life of a company before everyone's shares are underwater, and it's impossible to recruit. So I would just make sure, if you're going to do that, you pick typical what's normal band ranges, $2 to $5 million cap. I personally say avoid co-founders. That's my own my own 2 cents, and definitely avoid a board of directors. So just pausing here to see if anyone has any questions. How long should a company stay in the friends and family stage? Generally, each round you're raising gives you 18 months to 2 years of runway. You can always raise earlier if you end up hitting these milestones. So the first time around for me, I was in the friends and family stage for like 11 or 12 months. It took me 10 months to raise, and it took me 10 months to raise the entire friends and family round. And then it took me 2 months to get a term sheet, another month to close. So it was about a year before I entered the next phase. That was for the first time around. The second time around, I was in the friends and family stage for like 4 to 6 months. On the previous slide, you strong advisory board, and you mentioned a board of directors. What's the difference? Okay, so an advisory board and a board of directors are two totally different things. An advisory board is someone who advises the company. They have an option, an equity package that generally vests over 3 years. It's usually a quarter point of equity. It's someone you call every so often in order to get advice. It helps de-risk the business. So I usually have like a group of tech advisors, product advisors, performance marketing, regulatory advisors, right? These are all different types of advisors that are deep expert in an area that is the company needs support. None of those advisors have the ability to fire me. They are not part of the board of directors. They do not decide compensation. They do not decide anything that impacts the day-to-day operations of the business. So advisory board and board of directors, two totally different things. Okay, so we will move on to the next stage, which is the pre-seed stage, and talk about what happens there. So the pre-seed stage, you've now, I'm just going to close this chat because it's, the pre-seed stage is the next phase of the business. You're going to raise a little bit more money. In this stage, it's generally about $1 million round, sometimes a little less, sometimes a little bit more. The valuation goes up, so that's good news. So, low end is maybe about 3 million if you're raising at the very low end of this size round, and all the way up to about a 10, sometimes 12. I've seen $12 million pre-money valuation. Less common for first-time founders, more common for serial entrepreneurs. Again, this can be a party round. You don't formally need a lead investor. You don't need a board of directors. So punt on all of that. It's generally the same structure, a SAFE or convertible note. A priced equity round is much less common. That begins to trigger some of the board discussions. And now you sort of level up in the investor that you're talking to. So now you're going to be talking to angels, like formal angels, kinds that you see on AngelList, super angels. Super angels are people who can write 100K checks. I've personally had angels that have written $1 million checks, which is crazy that people have that much disposable income, but hey, they do. Sometimes your friends and family participate again and do their pro rata, or they do super pro rata, which means they invest more. You get into angel groups. So you might pitch to one person that says, I'm part of New York Angels, and I'm going to bring you in and you're going to present. And that's really good practice because it's the beginning of what happens for micro VCs, for accelerators, for VCs in the future. And so much of each of these rounds, and I say don't skip them, you're learning something that is going to apply in the future. When you begin pitching angel groups, that's the beginning of getting consensus around for multiple people. That's the beginning of getting peppered with diligence questions from multiple groups, people who have different experiences. You might have someone who's really strong on tech, or someone who did a healthcare investment and has PTSD from that. And if you're a healthcare play, they're going to ask all these professional questions as to like what went wrong with their other deal. Getting used to that cadence helps you as you go pitch more and more sophisticated groups. Micro VCs are important because just like building consensus in an angel group, you have one partner who's generally, the lead on the deal, and they have to go back to their partnership. And the partners are all evaluating other deals they want to do. So the fund has a pie of money, it's dry powder, and they're going to pick which deals. And so you may have really good conviction from the lead, but you actually don't have visibility into the other deals they're looking at. And so they may say, this deal is really great, but we have another opportunity where we could invest in a different company, and that's going to generate better ROI for us. So beginning to learn all of these nuances about fundraising, who you're talking to, why you're talking to, their motivations is really important. When you think about motivations, friends and family and angel investors are betting on you as the founder, or they have lived this problem. Angel groups, accelerators, micro VCs, they're all there for an ROI, return on investment, right? So that begins to shift. In the friends and family round, pre-seed, you'll get some of that in a mix. And then by the end of it, you're really just getting people who are like, let's talk money, let's talk investment. How is this going to return my investment? You may also join accelerators. This is a good pace to do that. If you're a first-time founder, accelerators can get you out into the world. They can fast track. It's like speed dating to meet tons and tons of investors and enhance your network. I did not go through an accelerator with my first company or second company. And it took me a really long time to build my network. And now that I mentor for Techstars, I'm like, wow, giving up 6% of your company to get Techstars logo in your deck, might actually make a lot of sense. I didn't think it made a lot of sense at the time when I was a first time founder, but now seeing like how many investors they get connected to in your permanent network for a group like Techstars or Y Combinator, that's really impressive. And that gives you permanent access. It's almost like a mini LinkedIn that they have inside of their accelerators that you can reach out to people. So it's all about building the network. Let's move on. I don't see any questions in the chat. So this is when you're going to start building the team. I remember the first time I did this, I really didn't know what good looked like. So I just hired anybody that basically had a resume that kind of indicated they had some experience in the role that I thought was where we needed help. So you're going to get good at hiring and firing. This is where the CEO is really important. They set the vision. They hire the team to execute the vision. They bring the money to pay the team to execute the vision. You're going to scale. If you raise $1 million, you can generally scale to about 6 people. You're going to start paying people. There are some ranges that are pretty typical. I always pay on a shoestring. So if you see like a CXO is 100 to 150K and you get 3 to 8% equity, you don't get 150K and 8% equity, right? It's a shoestring. So if you pick low end of cash, you get high end of equity and vice versa. So they pick the low end of cash, 100K, then they could get 8%. If they pick 150K, they get the low end and they get 3%. And those are sort of typical bands for junior hires, mid-level hires, lower executive, and executive hires. What are they going to do? Well, you're going to be iterating with your customers. You have to keep in the back of your head that in order to trigger a really healthy seed round, you need to hit $10,000 in monthly recurring revenue. If you are not going to hit that kind of revenue, then you have to have something done with a product that indicates the equivalent in investors' eyes to revenue. And that's, again, where you're beginning to see a shift from friends and family to VCs and investors who are betting on your ROI and how you're going to generate a return from them. In my opinion, product at this stage is generally a well-developed MVP that people are using, and you're beginning to understand customer acquisition. So you may not have CAC and LTV and MAU and DAU and all these fancy terms, like that comes a little bit later, but you're going to understand like, this is my customer. They're generally, males age 18 to 45. Their habits include, fantasy sports, retail trading, and they typically work in finance or, consulting. They went to these types of schools. Their income ranges is roughly like $50,000 to $100,000, and they're very social with their friends. Right? That's a profile of a user that you begin to understand. Here's what they do. Here are their other habits. Here's how I'm going to begin targeting them. I encourage people to try to begin generating revenue at this stage and have really positive customer feedback and experiences. In the next round, people may ask your customers, you may get the question to do 3 customer reference calls, much like if you're being interviewed for a company and they say, give me 3 reference checks, they're going to ask for 3 customer checks. Again, you really need a strong core team. So this is when you go to hire, I recommend looking at people, where did they come from? Hiring people out of startups is much more successful than hiring somebody from, a large company. There's so much that goes into this stage. Investors like it when they see this is like someone who's been early at a company. This is someone who's seen growth. This is someone who knows what's around the corner. So if you're a first-time founder, don't hire a team that's all new to startup land. Right? Make sure you're hiring people who are experts in the startup space. You're hiring, if it's a fintech company, like go find the most prominent fintech companies and try to hire out of there. And that little extra legwork will go a really long way in terms of bringing talent to your team that de-risks your business. I don't see any questions, so we'll move on. Okay, so pre-seed, this is definitely your last chance to do a 3-month cliff at a 6-year vest. Again, options are become more standard at this point versus restricted stock. Party rounds, super common, great way, to get some momentum, do some rolling closes. Again, I always encourage the safe over the convertible debt and avoid price rounds. For those of you who don't know, if you do a price round, that means all the equity converts, people can see where they are on the cap table. Often it comes with governance controls, which means that an investor can say, you have to come to me for approval to increase the option pool. That's a big pain in the butt. So I don't recommend it this early in the stage of the company. This is also where you have to start becoming more operational as a CEO. It's so fun to pitch the vision and kind of throw shit at a wall and see what sticks. But this is where you actually have to become super the beginning of training wheels of like operational mindset. So I recommend that you do bi-weekly reporting for the team. Every Monday, you share the goals for the week. So as CEO, my job is to bring the investors, do the recruiting, and try to strike business development partnerships. So every Monday I say, here are the people I'm interviewing, here are the investor meetings that I have, here are the partnership meetings, this is the work that we're doing. Every Thursday, I report on that. I am very honest if I accomplished or did not accomplish my goals. It's all done in an Excel sheet. So Monday is the day we set the goals, Thursday is the day we report, and then the next column is a box that is either red or green. Did I hit it or did I miss it? That's it. And if I pick red and I say I missed my goal, I'm leading with integrity, and other people are more likely to report that they missed goals as well. This is all the beginning of what comes next, which is OKRs, objectives and key results. This is ultimately what happens when you have a board of directors and you have annual goals, and then you get judged by how well you forecasted your annual goals, if you hit them or missed them, all the way into a publicly traded company where you're judged by quarterly earnings, right? So this is the beginning of that. Any questions? No. Okay, you guys are awfully quiet. Moving ahead to the seed round. So this is, again, it all becomes a little bit more real. This is where we're doing some revenue. We've got to expand the team. We're going to raise more money, and we're really beginning to think about that Series A. So in the seed round, they're getting pretty big these days. So 500K to 5 million. I raised $3 million in my first round as a first-time founder. It was like a $1 million round and a $2 million round, but it was 3 total. I didn't quite have the pre-seed, post-seed type of lingo. This time around, I did a second-time founder. I did a $4 million $4 million round and a pre-money of 22 pre. So you can see how they get to the high end of these. I've heard in Silicon Valley the standard for seed round is $8 million on a $40 million pre. Obviously, that depends where you are geographically, what your network is. But those are kind of some of the numbers that are rolling around right now. It's a very attractive financing environment for founders, very founder favorable right now. Very hard if you're a first-time founder and have zero network, but if you're in the right cities, Boston, New York, San Francisco, that's where the money is. I do encourage people to think about where they are geographically, because there's absolutely where you are enables you to raise more money based on the amount of VC dollars in that ecosystem. Okay, so structure of the raise, safe convertible debt. You do see equity rounds. If you are raising $5 to $8 million, you're raising at the top end. This is the beginning of where people are going to start pushing you to price your round. That means your friends and family and pre-seed rounds will convert. Everyone will have, a slice on the pie. So that cap table, shows your percent ownership. You'll have very clear visibility into what you owned. For first-time founders, I do recommend thinking about doing a price round. Part of that is because if you go through friends and family, pre-seed, seed, post-seed, and then get to a Series A, the Series A will be priced. You may be shocked at how much you diluted. If you're not doing a pro forma analysis and you're not seeing sort of the interest rate that's accruing, if you're doing convertible debt rounds, if you've had multiple caps, it might be very murky in terms of how much you actually own. And this is a really good way to level set. And I have seen investors at the Series A say, I can't do this round because you diluted yourself so much. You don't own what's in market as normal, and there's no way to fix this. So I'd recommend the price rounds that there's full visibility on where you are. It also helps prepare you for some of the corporate governance things that are happening. If you can avoid a board of directors and do a price round, I recommend it. Types of investors will be early stage VC firms. Usually those are firms that have under $100 million from their last close. So VCs, just like entrepreneurs, raise money. They have, fund 1, 2, 3, 4, 5. So you ask what fund you're in. You ask how much dry powder. So if it's a $100 million fund, they spend $50 million and they have $50 million to go. How many investments do they anticipate doing on that? Or did they just do a close and from the very beginning, they're going to be much more willing to take risk. The more money they spend within a fund, the more their risk appetite decreases. So think about that. There are seed specialist funds like Underscore and Streamlined. I really like working with seed specialist funds because they help tee you up. They have a huge network for their Series A, and so much of this is just building to the next round of financing. Let's see. Okay, the people are quiet. I just saw the chat. People are quiet because it's going well. Good information for everyone. All right, so you raised some money. Now you're going to expand the team. So this is where you really begin to grow. Generally, politics and crazy things will start to happen. Different levels and tiers of hires will begin to happen at this phase. So when you get to about 20 people, you'll have this CXO, the manager, the VP, and the junior hires. I really recommend trying to avoid using VP or senior VP or CXO as much as possible. Try head of or lead. So like lead engineer instead of VP of engineering, or head of product and marketing instead of CMO, as much as possible. Usually you want one or two CXOs. If you have 5 or 6 CXOs, investors are going to laugh at you, and that's going to be a ding on you. Mostly because someone who's a CXO at a seed stage is likely not a CXO, Series A, Series B, Series C, and so you're teeing that person up to get fired. If you listed them as head of, it becomes much easier to hire a true CXO post-Series A, post-Series C. So just keep that in the back of your head. These are the typical comp bands. You'll see that equity is going down. So it went from 5 to 8, or 3 to 8% for a CXO in the last round. Well, now it's 1 to 3%. The vesting is beginning to change. It's definitely closer to 1 year cliff, 4 year vest at this stage, and you're not seeing a lot of options versus you are seeing options, not RSUs. By the end of the seed round, this is where we were talking. You want to be targeting about $100K a month in recurring revenue. It's not just $100K a month, though. It gets a little more complicated and nuanced. It's more like $97,000 a month in revenue, $108,000 a month in revenue, $119,000 or $20,000 a month in revenue. Like last 3 months rolling, if you want to trigger a really healthy, really robust Series A, you want to look at the rolling 3 months, and you want to show not just roughly $100K, but you want to show month over month growth. So you need like both of those metrics to be really strong if you want to target a Series A at the top end of the range. If you don't have revenue, you need something else that would indicate why someone would say this company is going to be worth 20, 30, 40, 50, $100 million at the Series A. You definitely want a robust product at this point on paying customers. That's how you're getting to $10,000 a month. You need to begin to understand these, crazy terms about acquisition and churn, right? So this is where it becomes very analytical. How much money do you spend on an ad? That's your customer acquisition cost to get somebody to become a customer. How long is that person going to be a customer? That's their lifetime value. What is the ratio of cost to lifetime value? How frequently are they logging into an app? Every day, every month, every week, right? That becomes your monthly average user, your daily active user rates. How frequently do they churn? What is your tail, right? All of these things become the metrics that you need to be really strong at in order to trigger that Series A and make people feel like you know what you're doing. I hate the term product market fit. I absolutely hate it. It really was meant to be like Series B or C type of term, like put $1 in, get $10 out. This is the beginning of when investors are going to start asking you about product market fit. It's very stupid, but you're going to start hearing this term thrown around. You're going to hear things like negative churn, right? The elusive negative churn. So have that in the back of your head. If we move on to the next slide. And I see we have a question about advisors and investing as well. It's a long text, so it's going to take me a while to unpack that. Again, I mentioned that your team is going to have a 1 year clip before you invest. Tying to the question in the chat, how long do advisors take to vest? Advisors are always 3 years. I haven't seen cliffs with advisors. They're not being paid cash, and so their compensation doesn't have a cliff component to it. Just team members have cliff. Is typical 2 years a monthly with no cliff? Yeah, you can do 2 years. I recommend trying to push it to 3. It's kind of the same thing as 6 month cliff early on. But advisors, you generally want them to be 3 years, because if you think about the lifetime of a company, it's typically 7 to 10 years. So if you only have them investing for 2, what's their incentive to keep working later on? someone wants to come on as an advisor with terms above 1%. Yeah, early on, there's so many people who I get that 1% question all the time, and it drives me, pardon my language, freaking nuts. That is a typical predatory thing that happens with first-time founders. You will often get these people, I can add so much value, but I want 1% of the company. That's not market. Unless you're thinking of them as a board of directors person, to put in perspective, I had Jeremy Levin. I had a healthcare play as my first startup. I had Jeremy Levin, who's the former CEO of Teva, the largest pharmaceutical company in the world, and he had half a point of equity. And he went to all my Series A pitch meetings with me. He set up meetings with OrbiMed and all these super high profile companies. He traveled with me. He flew to Boston. He was based in New York. I flew to New York. He set up the meetings. He set up debriefs afterwards. And that guy, CEO of Teva, largest pharmaceutical company in the world, got 0.5%. So a chairman may ultimately get 1% plus, and a board member often can get 1%. It depends what stage you're at. He got that 0.5% at the Series A, which would have been 1% in a pre-seed or seed round. But he did a lot of freaking work for that. And he was on the board for years, 4 or 5 years. So it irks me when people say that it can add a lot of value. If you have somebody who's investing in the company, putting $10,000 or $15,000 in, they want to work to de-risk their investment. So they don't get additional shares on top of that unless they're adding a lot of value on the product side or marketing side, and you're giving them advisor shares on top of their investments. Okay, so going back to this presentation, when you think about your Series A, I'm really diligent in how I think about fundraising. So I don't just go out and talk to everybody. And Isabella knows this because she's done the work. When I think about a Series A, which is a really robust round, I build a list of 100 investors. And my new company is a retail trading platform. So you think about all the investors who invested in Robinhood or crypto platforms like Circle or Coin. You think about, the eToros or the Weebles of the world, right? You think about all those investors, and those companies are late stage. They're likely looking for another investment in the space versus someone who's also in the seed stage space. If Andreessen has just backed someone in the same space as me, then they're probably not going to do my deal. Then I look at adjacencies. So daily fantasy sports, because again, I'm going for a certain target user that has these phenotypes of behaviors that they do, companies, other places where they spend money, DraftKings, FanDuel, SuperDraft. I look at that investor base, right? So I build this entire sort of matrix of all the different things that may lead into these user behaviors and all the investors that have backed those companies. And I rank order these by 100 investors, A, B, C, D. A D is somebody who maybe closed a fund, but a couple of years ago, so they're tail end of the funds, their risk appetite is very low. Series A sounds in our world of early stage, sounds like it's the end of it's late. Series A is the beginning of when real stuff happens. It goes, typically goes Series A, B, C, IPOs. So Series A is the early stage for big investors, big money, real VCs. It has been a while since they closed the fund. I put them as a D. If it's a venture partner or an associate who I'm dealing with, I put it as a D. And ultimately, I pitch the D investors first and minimize the prevention questions, and then get to a C investor, then a B investor, then an A investor. I pitch the A investors last. And this process does take time, which is why it can take 6 to 9 months to overall do a financing from when you lock the deck in the model. You're iterating and you're seeing what the prevention questions are early on. So early on, someone, was can you really do this? You don't have a broker-dealer license. We got a broker-dealer license, right? We looked at the difference between the two. So we knew what those prevention questions were. And we were able to adjust for them so that by the time we hit our A-tier investor, it was the dream person. They were not on too many board seats. They were at a high-profile fund. They could write a $20 million check. They can follow the company for many years. I know a lot of entrepreneurs that work with them, and they're really excited with the experience they had. That's when it becomes the right time to make that person an A and to pitch that person. If a D or C wants to invest, how do you handle that conversation? Say you're taking commitments and you don't have a lead yet and you're working through that. And if they do end up putting forth the term sheet and they want to invest, then you got to hit the A investors more quickly. We have 5 minutes left, and I know people want to hear maybe a little bit on the Series A. I don't know if many people are at that stage yet in this group, so I want to make sure I leave room for questions. So we'll just hit that really fast. These are big rounds. priced, which means a board seat. You can have a chairman or an executive chairman. I actually really recommend working with the chairman. I paid them too much both times. I was really irritated about it, but they were really good for me ultimately. You get real institutional investors and VC firms. So a lot that I mentioned here. You may get super angels that participate, and family offices. On the next slide, you think about the team, you're beginning to really scale. You'll see huge equity bands increase. So they're going from like 0.01% all the way up to single digits. And you actually see a dip in how much you pay people because you have more junior people. I mentioned the product needs to be about $100,000 a month in recurring revenue. This is where you need to know all your stats, your KPIs, CAC, LTV, etc. And you really want to try to have consistent growth in this round. You're also forecasting how you can get to $1 billion valuation, which is generally $100 million in revenue. Most tech companies are valued at 10x revenues. And so that's the beginning of really thinking, if I know all my numbers, my CAC and my LTV, and I know how people are going to spend money, I know I can forecast out. In the interest of time, I'll move ahead and talk a little bit about the board that you're going to establish. So there's a couple structures. I recommend trying to keep it to 3. If you have to go to 5, fine. The fewer, the better. This is your training wheels. You're learning how to deal with the board. Don't go to 5 right away if you can avoid it. You might begin to have subgroups. I definitely saw that, Series B, Series C, finance subgroup, audit committee, comp committee, all of that. I mentioned, doing your weekly check-ins, then your OKRs. Now, as you get to the Series A, the board's job is to hire and fire the CEO and ensure you don't get sued. So the things that you have to do is say, okay, we're going to plan our annual goals. You don't want to get fired. You have to be really good at pointing and really good at estimating what your annual goals are, so that you can be appropriately judged by them, and get your team bonuses if you're profitable. And not get sued by other investors who think you made no progress. So I'm going to start taking questions. What if we do directly start at a Series A? What do we offer you to do? Well, I started this conversation by saying I don't recommend that because you don't learn everything that you need to learn across all of the different stages. You've just made your job a lot harder. I don't know how much you raised. I don't know if your company is already profitable, if there's a reason why you skipped all the other rounds. But generally, you really want to de-risk how you're yourself as an entrepreneur. If you're doing this for the first time, you want early investors in so you can practice on them and sort of understand the mechanics, understand the stages as you move ahead. I know we have just a couple minutes left. I'm starting to lose my voice. I guess there are no more questions. So recall, these are the operational goals across each stage. Zach, this is why if you're not good at biweekly reporting and OKRs, you don't want to go straight to a Series A.
So we have another question in the chat of, do you recommend any books or resources on dilution?
I am reading a good book right now. It's by a guy at Andreessen Horowitz. Give me 1 second. And he actually also explains sort of what VCs go through. And when you get really pernicious terms that are highly dilutive, when a VC has bad terms from their LPs, it kind of like shit rolls downhill, and then they offer really unflattering terms for everybody else. Give me a second and I will pull that up. Where can we find the recording? Rachel, I think you can probably answer that one.
Yes, I just posted in the chat. We'll be announcing where the recordings will be after DC Startup Week this year. We have another question in the chat. What tools do you recommend for managing your cap table and understanding dilution before a price round?
Generally, you'll have legal counsel that will help with that and do a pro forma analysis. And that pro forma will show you if you've done, friends and family with a $3 million cap, and you've done a seed round with a $10 million cap, and you're raising a $20 million Series A, and you think the price round is going to come in at $80 million pre versus $100 million pre, they're all toggles in a pro forma. And so your real legal team, because you didn't go with your friend who was a real estate attorney, right? You went with a real startup lawyer. They'll be able to create that pro forma for you. But it does require a lawyer doing it because it ties back to all the legal documents. And if it's like, if your safe note was a 3 million cap with a 20% discount, it's like with or and all of that factors into then the pro forma. I don't know why I cannot find this book. Okay, so it was by a guy from Andreessen Horowitz, and sure it's something like Jeff Busking has a great book, Mastering the VC Game. Highly recommend that book, and I'll try to work on the other one. Are there any other questions?
Amazing. Well, thank you so much, Zoe and Isabella, for an amazing presentation. For everyone who looked for the recording, definitely stay tuned on the DC Startup Week newsletter. We'll be announcing that post DC Startup Week as well. So we're kicking up day 2 of DC Startup Week. We have 3 full days ahead of us on Wednesday, Thursday, and Friday this week, full of virtual content, as well as today we're in person for the rest of the afternoon at DC Startup Week from about 12 until 7 for a ticket event. And then tomorrow we have our only in-person all-conference happy hour as well if you're looking to do some in-person networking opportunity. Starting up next at 11 a.m., we have a Founders on Fire chat with Adam Muchler and Gerard Yo, the co-founder of Fiscal Notes, all about the founder's mind. So please check that out at 11 a.m. And again, thank you so much, Zoe and Isabella, for an amazing presentation on What Stage Am I Anyway to help us figure out what stage and how to go about the fundraising process. So we really appreciate all your time, your energy, and your support.
No problem. And I couldn't find the exact book I was thinking of, but those are 2 other phenomenal ones that should get people started.
Amazing. Thank you guys so much.
Okay, have a good one. Bye.